In our last class, we started capital pricing model. Just as a recap, we said that capital pricing model is a model designed principally to establish the relationship between systematic risk and expected return of a risky asset, that is stocks. And we said that capping can be used for pricing risky assets. You can use capital pricing model to price uh, shares or stocks. You can use capital pricing model to generate expected return. You can also use capital pricing model for calculating cost of capital. Then we talk about the underlying assumptions of capital pricing model. We said that uh, one of the assumptions of CAPM is that investors are risk averse. That is, they are utility maximizing and then rational individual. Even though investors do not like risk, they still want to maximize return. And we said this is not applicable in practice because in an efficient market, it is not possible for a rational investor to wants to maximize expected return without taking a higher risk. Okay. Then the second assumption that we'll talk about is that investors plan to hold uh, investor plans to achieve a single holding period. That is, all investments will have a single time horizon, possibly a year. All right. Then the third one we talk about is that the investments is infinitely divisible. That is, fractional part of the investment can be undertaken for the foreseeable future. All right. Then we also said that uh, investors are price takers. That is, investors cannot influence. Okay, they can't influence price. All right. So whatever the market dictates is what the investor will accept. So they cannot influence the pricing. So these are some of the assumptions that we talk about in our last class. Of course, we also said that investors have homogeneous expectation. That is, uh, according for capping to be able to work effectively, this assumption we apply. One of them again is that, of course, investors have homogeneous expectation. That is, all investors they have the same thing as expected return. All right, they have the same expected return. All right. So those are of course, this is also very important. Yeah. Markets, one of the assumptions again is that markets are frictionless, which means that there will be no transaction costs, no taxation, which is not true because there is no how you are going to carry out investing decision without incurring brokerage fee. You need to pay brokerage fee to your broker. All right, because you as an investor, you can't just go to the market. You need to speak to some intermediaries. They are the one that will arrange your investment on your behalf. For example, your portfolio manager will be the one to manage your investment on your behalf. So that service that portfolio manager will render to you is not for free, right? So it's not for free. In any case, so I would now say again that there are two sides. There are two sides to uh, capital asset pricing model. The one side is the expected return, and the other side is the beta value, which is systematic risk. All right. Without wasting more time on this, under the beta, but we said that the most challenging area in capping is the beta value because on the day of your exam, um, There are different ways examiner can test you, right? And that's why it is important when you are calculating the capital asset pricing model, you have to know the exact formula to use for estimating your beta value, right? Because this is the formula you're already familiar with. We discussed it last time for calculating expected return, okay, or cost of equity using capital asset pricing model. The challenge is this guy, the beta value. Okay, the challenge is the beta value because the risk-free rate of return certainly it will be given to you. Market return may be given to you, or examiner may decide to give you a market risk premium. But the challenge, like I said, is how to estimate the beta value. And I gave you 5 different formulas that you can use to compute the beta value. One of the 5 formulas will be given to you on the day of your exam. One of those formulas is what we are going to use on the day of your exam. And that's why it is important, because you don't know what examiner will test. And that's why it is important for you to ensure that you master all the formulas. And we said that there are 2 types of beta, there are 3 types of beta value. There are 3 types of beta. Of course, we use beta to measure risk. Betas measure the sensitivity of asset return to that of the market as a whole. And we have 3 types of beta. We have positive beta, okay, negative beta, and then zero beta. We said that the positive beta indicates that the return of the asset follow the same direction as that of the market, okay? Then the negative beta indicates that the return of the asset is in the opposite direction of that of the market. And then the zero beta indicates that there is no relationship between the asset return and that of the market as a whole. There is no relationship between the asset return and that of the market. That is zero beta. And we said that the beta of the market is always 1, all right? The beta of the market is always 1, meaning that anytime you compute beta value, you need to benchmark against 1, against the market, all right? So if the beta of the asset is higher than 1, that means the security is risky, it's more risky relative to the market. If the beta of the asset or of the security is below 1, it means that the investment is less risky as compared to the market. But if the beta is 1, that means it's the same, the risk of the assets is the same as that of the market. So examiner will not tell all these things is implied in the question. Once you do your calculation and you notice that your beta value is, or the overall beta of the portfolio is higher than 1, then you should know what to do, or it's less than 1, you know what to do. So again, I gave you all this formula last time, all right? I gave you 5, but in this material, you have only 4. So go and work with the 5 I gave to you. At this point, let's have an illustration. If I'm able to solve 3 illustrations, that's okay. That's okay. Let's see. Let me see the question we're going to. Okay. Let's start with, let me see, which one is this one? Not this one. Let me see. Let's start with this one. Sure. No, not this one yet. Let me see. Uh, okay. Let's start with illustration number 2, please. Let me read. Prince Fernandez, a valued client of your stockbroking firm, has asked for your advice on his investment portfolio. He holds the following securities in the stock market, having the listed risk characteristics shown below, which is regarded as efficient. The staff of the investment department of your firm has estimated the expected return on shares in general, okay? Expected returns on share in general on the basis of past return and inflation expectation to be 20%. So which means that when you say expected return on shares in general, which means this is market return, okay? Market return. That's what examiner is trying to tell you there. It is expected that the risk premium will be about 5%. Remember, risk premium is different between market return and then risk-free rate of return. Okay. The risk of the market as measured by standard deviation is 8%. So this is the risk of the market, DM. All right, is 8%. Okay. All the three shares lie on the security market line. As a prelude to your advice, prepare the following computation for a discussion with your clients. 1. The expected return on your client's portfolio. 2. The risk of the portfolio, assuming the capital asset pricing model approach. All right? So that is the question. That is the question. So examiner is asking you, all right? Examiner is asking you to calculate expected return on your client's portfolio and the risk of the portfolio using capital asset pricing model. So what are you going to do? How do you solve this question? Now, let me explain before I switch. You want to calculate expected return of the portfolio. You will recall when we did portfolio theory, we said return of the portfolio is computed as the proportion invested on security. For example, where you have two asset portfolio, X and Y. So the proportion invested on security X multiplied by expected return on security X plus proportion invested on security Y, okay, multiplied by expected return on security Y. So this is the formula for calculating the return of the portfolio. But examiner is saying in this question that you should use capital asset pricing model. So if that is the case, what are you supposed to do for you to be able to get the return of the portfolio? The first thing first that you need to do is to calculate the return of individual security. And to calculate the return of individual security, you are supposed to calculate capital asset pricing model using the CAPM formula, right? But the challenge now is that the beta that you are going to use to calculate your CAPM is not given. So you must be able to determine it. Therefore, to now get the beta, you go to the question, what are the information given? You can see in this question, we are given standard deviation. Okay, standard deviation. We're also given the correlation coefficient, all right, which is R. This is standard deviation, all right, standard deviation of security. Then this is correlation coefficient. That means we are going to use the first formula I gave to you last time. All right, you are going to use the first formula I provided to you last time. So that is on that. Now, of course, examiner also told you that the risk of the market as measured by standard deviation is 8%. So you remember the first formula I told you that is the most frequently tested is the beta will be computed as correlation coefficient multiplied by standard deviation of security over standard deviation of the market. All right, so this is the formula we are going to use. In fact, because of time, let me switch quickly and then let's solve this. You don't need to waste too much time. All you need to do, just pay attention, understand the way we are solving it. All right, this is solution. So illustration number 2. That's page 97. All right. So the name of the company, um, Prince Fernandez is the name of the investor. So let me just call it Prince Fernandez. Okay. So examiner wants us to calculate expected return of the portfolio. Like I said, we can't just jump to calculating expected return of the portfolio. There are procedures you need to follow. First thing first, we need to calculate expected return of individual security. Calculate expected return of individual security using CAPM. That's first step. In fact, the first step is supposed to be calculating the beta value because you are going to need the beta value to calculate the expected return. All right. Let me see if I can copy this and paste. All right. Okay. Let me give a space. Like that. So I'll come here. The first step is to calculate um, step one. Calculate beta value of each security. Okay. Then step two, you then calculate the expected return of individual security using CAPM. Then step three, you estimate the return of the portfolio. Estimate the return of the portfolio. Then step four, you calculate or determine the risk of the portfolio. Examiner says you should use CAPM method. All right. This is not a standard steps. So this step are for solving this question. This is not a standard. Don't go and memorize this to thinking that okay, anytime you want to calculate expected, this is the way to follow. No, this one relates to this question. This procedure relates to this question. It's not that this is how it will be all the time. No. The way the question comes will determine the approach that you are going to adopt. Therefore, we want to calculate beta value. I will then come here calculating beta value because I'm going to need this beta value for calculating my capping. Therefore, how am I going to calculate my beta? I provided you in our last class, I provided you 5 different formulas that you are going to use to calculate your beta. So in this question, because we are given correlation coefficient and standard deviation, therefore, beta value will be estimated as correlation coefficient multiplied by standard deviation of security over standard deviation of the market. So we do for each security, we have security X. So we then go back to the question. Let's go and pick the numbers. What is correlation coefficient of security X? According to the question, correlation coefficient is 40%, and the standard deviation of security X is 15%. Therefore, 0.40 multiplied by 0.15 over standard deviation of the market. According to the question, we are told that the risk of the market as measured by standard deviation is 8%. All right, so standard deviation of the market is 8%. Therefore, what do we have here? Bring out your calculator. 0.4 multiplied by 0.15 equal divided by 0.08 equal, that's 0.75. That which means that the risk of security X is less risky than the market, because this is less than 1. Security X is less risky than the market, which is okay. All right. Then security Y. The correlation coefficient of security Y is 60%. Standard deviation of Y is 14%. So 0.60 multiplied by 0.14. The risk of the market is 8%. All right. So what do we have? Let me check.
1.05.
Okay. 1.05. All right. 1.05. This means that security Y is relatively higher. The risk of security Y is relatively higher than that of the market. Okay. So you compare this 1.05 with 1. The risk of the market is always 1. So Z equal. Then for security Z, the correlation coefficient is 80%. Standard deviation is of security Z is 5%. So 80% multiplied by 0.05 divided by 0.08, which is the risk of the market. All right, what do we have here?
0.5.
0.50. Again, security Z is less risky than the markets. Okay. Now that we have computed the risk of individual security, then we need to calculate the expected return of individual security. So calculating expected return. All right. Expected return of individual security. Okay. So what are you supposed to do? Of course, you are supposed to use CAPM. So I would then say cost of equity equal to risk-free rate of return plus beta into market return minus risk-free rate of return. This is the formula to calculate capital asset pricing model. You're already familiar with this. Therefore, I will do for security X. According to the question, what's the risk-free rate of return? We are told that, now, we are told in the question that we are not given risk-free rate of return, but the examiner told us that the return of the market is 20%, and you're also given the risk premium to be 5%. Look at, let me show you the risk-free rate of return. Before this, let me show you. Note, the risk-free rate of return is not given. RF is not given. However, this will be computed. However, it will be computed as the difference between the market return RM and market risk premium. That is RM minus RF. So in this question, we are not given risk premium. Sorry, we are not given the risk-free rate of return. We are only given the return of the market to be 20%. We are also given risk premium to be 5%. And you know already that this is RF. You know that according to the question, we are given RM to be 20%. You're also given the difference between RM and risk-free rate of return, which is known as risk premium, to be 5%. Out of 3 variables, you have been given 2 variables. Therefore, you can always estimate the unknown variable. So I can then say the risk-free rate of return is equal to market return minus the risk premium, which is RM minus RF. Okay, so the risk-free rate of return is equal to 20 minus 5. RF is equal to 15%. All right, so you have to shine your eye. Okay, so now that we have the risk-free rate of return, we can then proceed to calculate the CAPM for each security. So for security X, risk-free rate of return is 15% plus what's beta of security X? We calculated beta of security X to be 0.75. Yes, the beta of security X is 0.75. All right. So 0 points. Don't start again. I think it's not connecting. What's wrong with you? I don't know. Just give me 1 minute. Let me close this. All right. All right. So the risk of security X is 0.75, 0.75. The market risk premium is 5%. So here will be 5. There is no need for you to do RM minus RF. Examiner has already told you that the difference between RM and RF, which is risk premium, has been given to you as 5. Therefore, what do we have here? 0.75 multiplied by 5 equal, then plus 15 equal 18.75%. All right. So the expected return of security X is 18.75%. Then we do for security Y. Risk-free rate of return is 15. The beta value of security Y is 1.05 into risk premium of 5. So what do we have here? 5 multiplied by 1.05 equal, then plus 15, 20.25%. Then for security Z, risk-free rate of return is 15. The beta of security Z is 50%, 0.50, multiplied by market return of 5. All right, this should give us 17.5. Let me confirm. I'll use calculator. 0.5 multiplied by 5 plus 15. That's 17.5. Okay, so we have calculated the expected return of each security. We can then proceed to calculate the return of the portfolio. So to calculate the return of the portfolio, examiner is saying that we should use capital Z pricing model. So requirement number 1. Requirement number 1, estimating the expected return of the portfolio. Okay, using CAPM. So in this case, we've already calculated return of individual security. So I can then say return of the portfolio equal to the proportion invested on security X multiplied by expected return on security X plus proportion invested on security Y multiplied by expected return on security Y plus proportion invested on security Z multiplied by expected return on security Z. Okay? Therefore, return of the portfolio equal. According to the question, we are told that 30% will be invested on security X, 40% on security Y, 30% will also be invested on security Z. Therefore, here is 0.30, that's the proportion invested on security X, multiplied by expected return on security X is 18.75. Plus, we invested 40% on security Y, multiplied by the expected return on security Y, which is 20.25, plus, we're investing 30% on security Z, multiplied by the expected return on security Z, which is 17.5. Therefore, return of the portfolio would then be equal to 0.3 multiplied by 18.75. Let me use a calculator and get the whole answer once and for all. Or let me just break it down for you. 0.3 multiplied by 18.75 equal, that's 5.625. 5.625 plus 0.4 multiplied by 20.25. That's 8.1 plus 30%, 0.3 multiplied by 17.5, 5.25. Therefore, then add the three of them together. The return of the portfolio
18.975.
18.9, did you say 975?
Yes, sir.
18.975. Okay, so that's approximately 19%. Return of the portfolio is approximately 19%. Okay, so that answers the first one, the first requirement. The second requirement says you should calculate the risk of the portfolio using CAPM. All right, so calculating the risk of the portfolio. All right. So to get the risk of the portfolio, follow the same pattern. So you are going to take the proportion invested on security X multiplied by the risk of security X plus proportion invested on security Y multiplied by the risk of security Y plus proportion invested on security Z multiplied by the risk of security Z. We are using this method because examiner says you should use capital asset pricing model method. So that's that. So we are investing 30% on security X. Multiplied by the risk of security X is 0.75 plus 40% is invested on security Y. Multiplied by the risk of security Y, which is 1.05 plus we are investing 13% on security Z multiplied by the risk of security Z, which is 0.50. So 0.3 0.3 multiplied by 0.75. That's 0.222. 0.225 plus 40%, 0.4 multiplied by 1.05. That's 0.42 plus 0.3 multiplied by 0.5. That's 0.15. Then we add it up. We had the three of them. Plus
0.7
0. What?
795.
795. Therefore, the risk of the portfolio is 0.80, which is relatively lower than that of the markets. All right, the risk of the portfolio is lower than that of the market, which is okay. All right. The return of the market, according to the question, the return of the market is 20%, and the return of the security is 19%. You can see the return of the market is 19%. The return of the security is 19%. The return of the market is 20%. So the return of the security, of the portfolio is lower than that is relatively lower than that of the market. And the risk of the portfolio is 0.8 relative to market risk of 1. Okay? So that's what the examiner asks us to do. We have calculated uh, the expected return of the client's portfolio. We also calculated the risk of the portfolio. So that's end of the question. Let me know if you have any question for me so that we can move to another examples. All right. So let's move to another question. Let me stop sharing this. I want to believe we are recording. Let me check. Yeah, before it's too late. So let me stop sharing this aside. So let's have another illustration. Let me see. Let's do this way. Trying to pick some scenarios. Let's solve this illustration number 3. Just in case you have similar question like this, how do you treat it? All right. Company X has a profit. Sorry, company X has a project with a lifespan of 1 year. Company Y has 3 projects with in different industry, each lasting 1 year. The net cash inflows and beta factors associated with the project are as follows. The market return is 10%. That's your RM. And the risk-free rate of return, RF, is 5%. You are required to calculate the total present value of the project undertaken by company X, then company Y. B, determine the overall beta factor of company Y, assuming that all the projects are undertaken. C, explain how portfolio diversification reduces the risk experienced by any investor. All right, so we want to calculate the present value. How do you compute present value? You can see in this question, based on what we have done under capital budgeting, present value is computed by multiplying cash inflow with the discount factor, right? So you have been given cash flow for each of the projects. So you have been given cash flow for each of the projects. So all you need to do is to discount. Each project has 1 year life. Therefore, you need to discount the cash flow at the appropriate cost of capital. So in this question, you are not given cost of capital, but you are given information to calculate capital asset pricing model. Because you are given market return, you are also given risk-free rate of return. So in this case, we are going to use capital asset pricing model to calculate cost of equity, right? Then the beta factor of individual security is also given to you. Therefore, I will stop sharing this and quickly move to the working notes. Let's see how we are going to turn it around. Solution to illustration 3. Still on page 94. Let me confirm. 98. That's page 98. All right. So the next thing we are going to do, we want to calculate. Examiner is asking us to calculate present value for each company. Okay. So how do we do this? To get the present value, you multiply cash inflow with the discount factor. Let me put it down. A, calculating present value, PV. This is computed by multiplying cash inflows with the discount factor. All right. So discount factor is not given to us. What do you then do? Since cost of capital is not given, the information on CAPMs will be used to estimate the rate of return as shown below. Okay, so let's do it together. First thing first, before you be able to calculate your present value, you need to first of all calculate capital asset pricing model for each project. So the first project is let me see, what's the name of the first project? For company X, we want to calculate, before that, calculating capital asset pricing model. So cost of equity equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So for company X, the risk-free rate of return according to the question is 5%. Market return is 10%. So here is 5 plus the beta of company X is 1.2. We are given a beta of 1.2, beta factor of 1.2 for company X. Market return is 10%. Risk premium is 5%. So this will give us 1.2 multiplied by 5. Then plus 5. That's 11.15%. Okay, 11.15%. Then for company Y, let's calculate CAPM, cost of equity for company Y. Company Y has 3 projects. So for project 1, risk-free rate of return is 5 plus the beta factor of project 1 is 1.5. Here is 1.5. Difference between 10 and 5 is 5. Okay, so 1.5 multiplied by 5, then plus 5. That's 12.5%. Then we'll do for project 2. Let me check. Somebody is sending message. Hey, how did you get 11.5? 11.5 is 1.2. Okay, 1.2 multiplied by the difference between 10 and 5, which is 5. Multiplied by 5. Oh, error. Supposed to be 6. 6 plus 5, 11%. Laura, you should have speak up now. This one is 11%, not 11.15. All right, next time, Laura, you speak up. Okay, this answer appears incorrect. Please check again. If I don't check your message, would have gone far. All right, for project 2, the risk premium is still 5. What's the beta factor? Give me the beta factor of project 2.
5.
I didn't get
1.5.
1.5, okay, into 5. So it will be the same thing as 12.5%. Then for project 3, here is 5 plus, what's the beta factor of project 3?
0.9.
0.9 into 5. So this will give us, that should be 9.5%. Because 0.9 of 5 will give us 4.5. Then plus 5, that's 9.5. So now that we have computed the expected return of each company, we can then proceed to calculate the present value. Okay, we can proceed to calculate the present value. So like I said, to calculate the present value, we are supposed to multiply cash inflow with the discount factor. So I would then say calculating present value for company X. Before that, let me give you the formula. Present value is equal to cash flow multiplied by discount factor. Okay, it's the same thing we did under capital budgeting. To get NPV, you multiply cash flow with discount factor. So for company X to be equal to the cash, what's the cash flow of company X?
100.
Pardon?
100.
100. Remember, discount factor is 1 plus r raised to power minus n. Okay? All right. So in this case, the cash flow is 100 million naira, then multiplied by discount factor of year one, which is the cost of capital of company X. We calculated 11%. We calculated 11% for company X. Therefore, 11% plus 1 will give us 1.11 raised to power minus 1. The useful life is 1 because each of the company has 1 year project. All right. Therefore, I will then say 1.11 raised to power 1 minus equal, okay, then multiply by 100. That's 90.10. Here is 90.10. Our figures in million. Okay, then I will do for company Y. Company Y has three different projects. Project 1. What's the cash flow of project 1 for company Y?
25 million.
25 million. Multiplied by the discount factor of project 1. Cost of capital for project 1 is 12.5%. Therefore, it will be 1.125 raised to power minus 1. Okay? So this will give us 1.125 raised to power 1 minus 1.125 raised to power 1 minus equal, then multiply by 25 equal 22.22. 22.22. Then project 2. What's the cash flow of project 2?
25 million.
25 multiplied by the same cost of capital, 1.125 raised to power minus 1. So we have the same answer. Then cash flow of project 3.
50 million.
50 million multiplied by 0.095. The cost of capital we calculated for project 3 is 9.5%. Okay, so raised to power minus 1. So this will then give us 1.095 raised to power 1 minus equal, multiply by 50 equal, that's 4566. 45.66. So you then add it up. What's the addition? What's total present value? Let me use my calculator since you are not ready. Um, 44.44 plus
Sir,
45.
is 90.1.
Yeah, it's
90.1.
90.10. So examiner asks us to calculate present value. Calculate total present value of projects undertaken by company X and company Y. We have done that. We have done that. So the B part of the question, you have to determine the overall beta factor of company Y, assuming that all the projects are undertaken. So you want to calculate the risk of the portfolio. Examiner is asking you to calculate the risk of the portfolio. Remember, beta measures risk. It measures the sensitivity of a project risk to that of the market. Therefore, I would then say calculating overall beta for company Y. Okay, how do I do this? Remember, I gave you 5 different formulas that you can use to calculate beta value. Remember, in this question, we have given beta value. Examiner has given us beta value for each security, which is what we use to calculate the capital asset pricing model, expected return. But examiner is now asking you again to calculate overall beta factor. So which means that you want to calculate the beta of the portfolio for company Y. So to do this, you need to shine your eye. Out of the 5 different formulas that I give you, which of the 5 do you think is the most appropriate to calculate this? Quickly, give it to me. Which of the 5 different formulas I gave to you, in the order I gave it to you, which of them do you think is appropriate to calculate the overall beta? The first one I gave was that if you are given correlation coefficient and standard deviation, we use the first one. In this question, we don't have standard deviation, we don't have coefficient of, we don't have a correlation coefficient, so that one is out of it. The second formula I gave to you is where you are given covariance and then the variance of the security of the market. Again, in this question, we don't have covariance, we are not given variance of the market, so that one does not apply. The third formula I gave to you is that if in the question you are given share price, number of shares, and the beta factor of individual securities, then the beta of the portfolio will then be total weight divided by total market value. Okay, then the fourth one, in this question, you are not given number of shares, right? You are not given number of shares. You are also not given share price, but you are given beta of individual security. Remember, present value and market value is the same thing. When you say present value, what you are simply saying is market value. Therefore, it is that the third formula that we are going to use to solve this without wasting time. So to do this, first thing first, you already know the market value to be for company Y. We calculate market value to be 90.10, right? Then the next thing you need to do is to then calculate the weight, the total weight of individual of the total weight of the portfolio. So to do this, I will just come here, projects. Since we've already calculated present value, so our market value, no need to stress yourself. Just say present value. Then we have the beta factor of individual security. Then you create another column for weight. So we have project 1, project 2, project 3. We calculated present value for project 1 to be 22.22. Project 2 is 22.22. Project 3 is 45.66. All right. And we calculated the total. Total present value to be 90.10. All right. So the beta factor of project 1 is 1.2. 1.2. And then the beta factor of project 3, what do we have? That's, sorry, 1.5, 1.5, then 0.9. Here is 1.5, 1.5, and then 0.9. So to now get the weights, you need to multiply the present value with the beta factor. So I would then say 22.22 multiplied by 1.5 equal 33.33. The same thing, 33.33. Then 45.66 multiplied by 0.9. That's 41.09. So you then add it up. Plus 66.66 equal. That's 107.107.75. 4. Okay, 754. All right. So to now get the overall beta, the beta of the portfolio, you then divide. I will say beta. Let me use B. Overall beta equal to total weight divided by total market value, which is the same thing as present value, equal 107.754 divided by 90.10. So the overall beta, what do you have there? What do you have?
1.20.
1.20, right?
Yes, sir.
Okay. So I would then say the overall beta of the portfolio is 1.2. Okay, let me go back to the question. Yeah, to determine the overall beta factor of company Y, assuming that all projects are undertaken. Okay, so I would then say the overall beta of company Y's project portfolio is 1.2. This means that the risk of the portfolio, the risk of the project portfolio is higher than that of the market, which is 1. Okay, that's that. So that answers that. Then number C part of the question, you have to explain how portfolio diversification reduces the risk experienced by any investor. So I explained this to you in our last class under portfolio. Yes, Rose Simon.
Good evening, sir.
Good evening. Talk to me.
Sir, so based on this solution you just did now, if I can get you right, the formula we use here is beta equals to ROS minus ROF divided by ROM minus ROF. Am I right?
The beta I use.
The formula you use for this table that you just
It's what?
is it ROS minus ROF divided by ROM minus ROF?
You mean this
But I'm
table?
trying. Yes.
I'm not used. This is a format, Sinas. Didn't you attend the last week? I mean, a few days ago on Saturday, when I introduced you to CAPM, I gave you the format you are supposed to use. So this is just a format, not a formula. This is the formula you are supposed to. This is the main formula. This one is the format to get the formula. Do you get Rose?
Okay.
So it's the formats that you are going to like this method is used. This is the formula here. Total weight divided by total market value. You use this if in the question you are given share price, number of shares, and then the beta factor of individual security. That is only when you use this format. So for you to be able to apply this formula, you need to first of all work out what is the weight. You need to calculate the weight. You need to calculate the market value before you now apply the formula. All right, Rose?
Thank you.
Yeah. No worry. As you proceed, you are going to see similar question, especially when we get to alpha value. All right? Okay. Now, the C part of the question, you have to explain how portfolio diversification reduces risk. All right, so I would then say how portfolio diversification reduces risk. So when we had portfolio theory, I explained to you that portfolio diversification is a strategy usually adopted by a rational investor by ensuring or by investing in securities that will react to market gyration differently. So to minimize the portfolio risk, you need to diversify the securities in the portfolio. That is, you don't put all your eggs in one basket. Portfolio diversification is designed to help a rational investor to avoid a catastrophic or disastrous investment outcome by not putting all your eggs in one basket. So that's basically and I said how to minimize portfolio risk. I said to minimize portfolio risk, investors should invest in securities that are negatively correlated or securities with no correlation. Also, to achieve a well-diversified portfolio, investors should consider international diversification. That is putting your investment out of the shore of your domicile country. All right. So now examiner is asking you how portfolio diversification reduces risk. How do you reduce the risk of the portfolio through diversification? You then say, let me just put something for you. Portfolio diversification is a strategy. It's an investment strategy designed to reduce portfolio risk by investing in securities or assets. By investing in securities or assets that will each react, let me rewrite that, to market gyration differently. So to reduce portfolio risk, investors should consider, or investors should invest to reduce portfolio risk. A rational investor should invest in securities that are negatively correlated. That is correlated. That is investors should invest in securities that are negatively correlated. That is securities that are in opposite direction of each other, or securities with no correlation. All right, so that is how to minimize portfolio risk. For you to be able to mitigate against risk exposure, you have to consider investing in securities that are in opposite direction of each other. All right, so that answers the requirement number C. So let me know if you have any question for me. Let's move to alpha calculation. Let's move to alpha. Again, Anjorin is not in this class. On Saturday, she did not attend my class. I know some of you that are very frequent in my class, especially those of you that usually read questions. All right? If you're absent, I will know. I'm not sure if Kemi is in this class. Kemi is not here. No worry. Amarachi,
No, sir. Me, sir.
how are you? I purposely called your name. You know, we spoke, was it not yesterday or today? Right?
Yes, sir. Yes, sir.
When I was accusing you that you always miss my class, you say, no, you've been attending. I intentionally searched for your name. All right, no worries. Keep it up. Let's move on. So let's go to alpha calculation. Let's go to alpha, and that's where we are going to stop. We are going to solve two questions under alpha. All right. Remember, a few days ago when we had the introduction to CAPM, I mentioned there are different ways examiner can test you under capital asset pricing model, right? Now, it is also possible examiner can ask you to calculate alpha. And we said that alpha represent the difference between the expected return and the required return of securities in a portfolio. And then I advise and I said that anytime you compute your alpha value, you are supposed to interpret your results. I gave you three different interpretation just as a recommendation or advice, because it is not sufficient for you to calculate alpha without making a recommendation or advice or making a suggestion on what your client should do. We said that if expected return is higher than the required return, the result will be positive. Therefore, what should your client do? In as much as expected return is greater than the required return, so it means that the security is undervalued. That is, the intrinsic value of the security is more than the actual value. So when that happens, your advice should be that the client should hold on to this. The client should buy more of the securities. So that security that is undervalued, you buy more of it, so that when the price changes in the future, you can dispose it off and make more money. All right. So whenever expected return is higher than the required return, it means that the security is undervalued. So if the security is undervalued, what do you do with it? You buy more of the security because the intrinsic value is more than the actual value, right? So that is that. Then the second one is if your expected return is less than the required return, it means that, of course, that will give you a negative alpha. So which means that the security is overvalued. So when the security is overvalued, what are you supposed to do? Your advice should be that the security should be disposed of. The security should be sold. Or if you are just buying it, if you want to buy, then you say the security should not be bought because it's not feasible. I mean, because the intrinsic value is less than the actual amount that is being traded. Therefore, don't buy such a security. Do not buy such a security. Then the third one is a situation whereby the expected return is equal to the required return. So that is, once your expected return, once your alpha is equal to 0, so this simply means that the security is rightly or properly or fairly priced or valued. So when this happens, what are you supposed to do? What advice should you give to your clients? Because your alpha is equal to 0, which means that the security is fairly priced, then your advice should be that the company should hold on to the security. Company should hold on to the security. So these are the three ways in which you can make recommendation or suggestion or put up an advice in relation to alpha. So let's look for questions that relate to alpha. Then how do you compute your alpha? So quickly, let me stop sharing this and move to the question material. Okay, we want to calculate alpha. Let me look for questions that relate to alpha value. Okay, let's start with illustration number. What's the time? Okay, let's solve this illustration number 7 first. We are going to solve illustration 7 and 8. 7 and 8. So let's start with illustration number 7. In the illustration number 7, you are told that capital asset pricing model is an equilibrium model of the trade-off between expected portfolio return and unavoidable risk. What are the basic assumptions on which this model is based? Examiner is asking you, what are the underlying assumptions of capital asset pricing model? Remember, one of the assumptions is that investors are risk averse. That is, investor wants to maximize utility, and then they are rational individual. That's one assumption. Assumption 2 is that investors are risk taker. All right, that is, they can't influence price. Sorry, they are price taker. Investors are price taker, meaning that they cannot influence the price. Whatever the market gives to them as a price is what they are going to take. All right. Then 2, the investments are infinitely divisible. That is, fractional parts of the investment can be undertaken. Then number 4, investor planned for a single holding period. That is, one time the same time horizon. Investors will have the same time horizon on their investments, maybe a year. Then number 5 is that investors are I don't know if I've mentioned risk averse. All right, I think I've done that. So these are some of the underlying assumptions of course, another one is that investors have homogeneous expectation of belief. That is, if all investors, they have the same the expected return. Okay, homogeneous expectation. Your expectation is to maximize your return. So the assumption says that investors have homogeneous expectation of belief. So these are some of the underlying assumptions of capital asset pricing model. Bonus mark, just master, I put it there. You can imagine, out of 100 marks, if you get 6, you are looking for 94. So it's a good one. Before you know it, in fact, anytime you see CAPM in a question, it should be one of the questions, the first questions that are going to solve, because it doesn't take time and it's always very straightforward. Then number B part of the question, you are told that currently the rate of return on the federal government bond redeemable at par in the year 2018 is 5%. Okay, so remember, examiner said the rate of return on the federal government bond redeemable, federal government bond. So which simply means that is your risk-free rate of return. Remember, risk-free rate of return is the rate of return that is associated with government security, like treasury bill, like federal government bond. So those are examples of risk-free rate of return. So examiner has given you risk-free rate of return, RF, to be 5%. The securities of 4 companies, Akira PLC, Bombardier PLC, Courage PLC, and Define PLC, have expected return of 12%, 9.5%, 10.5%, and 13% respectively. The average expected return on market portfolio is 10%. So that's the market return. So here is market return, which is 12%, subject to a 6% risk, that is standard deviation. All right, so we are given market risk to be 6%. Other relevant information relating to the 4 securities of the company is as stated below. All right, so you are given information on standard deviation of security. You're also given information on correlation coefficients. So something should tell you that you are going to calculate beta value. All right. So you are required to show which of the companies is or are overvalued. So you can see in this question, examiner is asking you to ascertain which of the companies are overvalued. So what this simply means is that you need to calculate alpha value. You need to calculate alpha. You can see examiner did not mention alpha value, but it is implied in the question, because even in the requirement, examiner says you should calculate, you should determine which of the companies are overvalued. So, and you know that it is only under alpha that you are going to determine which one is undervalued or overvalued. So, how do you then solve this question? The first thing you are going to do is to calculate in the question, examiner did not give to you beta factor. Therefore, you need to calculate beta factor of individual security. That is, you calculate beta factor for Akira, Bombardier, Courage, and Define. So once you calculate your beta factor, then you need to go and calculate your required return. Your required return is the same thing as capital asset pricing model. The expected return is already given to you, so no need to sweat on that. So because of time, I would like us to finish through illustration before we close the class tonight. So let me quickly go into solving this question. All right. So this is solution. Solution. Don't start again. Okay. This is solution to illustration illustration, I think that's illustration 7. What page? Let me check. Illustration 7, page 100. Okay, so the name of the company is let me check. This is not it. That's not it. We're not given the name. Are we given the name of the company? Yeah, we're not given the name of the company. So in this case, the first thing, like I said, you need to do, the first thing you are going to do, the first thing you are going to
Page
do
101.
it's not 101, it's 100. All right, it's 100. It extended to 101. It's not even extended, it's just 100. Okay. Now, the first thing you are going to do is to calculate beta factor. So I would then say, let me help you further. This question relates to calculation of alpha value. Why? Since you are required to determine since you are required to ascertain which of the securities is or are overvalued. So that's why we know that. Not only that, not because of these requirements. Also, in the anytime you are given expected return in a question, you should know that you are going to calculate alpha value. So it's not just because of the fact that examiner asks you to ascertain which of the security is or are overvalued. So, and expected return is also provided for each security. So in this case, what are you supposed to do? The first step is to calculate beta factor of individual security. So step 1, calculate beta value. Calculate beta value. Then step 2, calculate CAPM. Calculate required return. Using CAPM. Then step 3, determine alpha value. Okay. Then step 4, advise or recommend. So usually when you have any question on alpha value, these are the procedures that you're supposed to carry out. It's not a procedure per se, but just to guide you on what you need to do. Therefore, let's calculate the beta value. So I would then say calculating beta. This one is more like a working. Calculating beta value. So you then need to ask yourself, pay attention. You then need to ask yourself, what kind of beta value am I going to, which formula am I going to use to calculate my beta value? You go back to the question. The question will surely tell you, the information given in the question will tell you how you are going to calculate your beta value. So in this question, we are given information on standard deviation and correlation coefficient. That means we are supposed to use the first formula I gave you last time. Therefore, I would then say beta value equal to correlation coefficient multiplied by standard deviation of security over standard deviation of the market. Okay, so that's that. Therefore, we then calculate for each one. The first one is Aquila PLC. What is, please, you have to support. Let me look for one of you that will be providing me number. I don't want everybody to be talking like we're in the market. Let me look for, yes, who will be providing me the numbers? I need one of you. If not, I will choose one of you to do that. I need somebody to be giving me numbers. Yes?
I will.
Okay, Glory. Yeah.
I will.
So, thank you. No other person should talk apart from Glory so that we maintain the sanity in the class. So for Hahira, the correlation coefficient of Hahira is 0.975. Let me start from there, 0.975. Here is 0.975. So Glory, what's the standard deviation of Hahira? Glory,
Question, no.
pardon?
Sorry,
Okay. 0.0870. What? Let me check. 0.80. 0.80. 0.800.
It is 0.080.
0.80. Thank you. So divided by the risk of the market. What's the risk of the market? According to the question, you are told that subject to a 6% risk, that is standard deviation of the market is 6%. So I would then come here will be equal to 0.06. So give it to me. What do you have there? Within the next 10 minutes, we should complete this question.
1.3.
1.3, thank you. Let's make it 2 decimal place. Is it just 1.3?
Yes, sir.
Okay, 1.30 then. Then, after Hahira, we have Bombardier. Give me the correlation coefficient of Bombardier.
0.640.
0.640 multiplied by the standard deviation of Bombardier.
0.075.
0.75 divided by 6, which is risk of the market as measured by standard deviation. What do we have?
0.8.
0.80. Then for courage, give me the correlation coefficient of courage.
0.740.
0.740 multiplied by the standard deviation of courage.
0.090.
0.90 divided by 0.06. What do you have?
0.111.
0.111. What do you say is the answer? 1.5.
1.11.
1.11. Okay. Let me confirm that number. 0.74. 0.74 multiplied by 0.090. Okay, equal divided by 0.06. Yeah, correct. Correct. Then number for divine. Give me the correlation coefficient of divine.
0.680.
660. Standard deviation of divine.
0.150.
150 divided by 0.06.
Sorry, 0.680, not 660.
680. Okay. So multiply by 0.150 divided by 0.06. What do we have?
1.7.
1.7. Okay. Here is 1.7. So now that we have computed the risk of individual security as measured by the beta value, we can then proceed to calculate the capital asset pricing model, that is required return. We need to calculate required return of individual security. Okay, so calculating required return, RS, using CAPM. Okay, so required return equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So for AHIRA, what's the risk-free rate of return given to us? According to the question, we are told that the rate of return on the federal government bond redeemable at par in the year 2018 is 5%. So risk-free rate of return is 5%. So you're also told that the average expected return on market portfolio is 10%. So market return is 10%. So I would then come here. Risk-free rate of return is 5. What is beta of AHIRA? We calculated beta of AHIRA to be
1.30.
1.30. Here is 1.30. Market return, we are given 10% minus risk-free rate of return of 5. So give it to me. What do you have there? Then we do for Bombardier, which is 5 plus the beta of Bombardier, we calculated 0.8. 0.80. So the difference between 10 and 5 is 5. So this one should be 9, right? This one should be 9%. Then for Horage, what's the beta value for, sorry, what's the expected value for the required return of AHIRA?
11.5.
11.5. 11.5%. Okay. Then for Courage, 5 plus the beta value of Courage, we calculated 1.11 into 5. So what do we have there?
10.55.
10.55. 10.55%. Then for Divine, 5 plus 1.7 beta value multiplied by 5. So what do we have?
13.5. 13.5.
Did you say 18?
13.5. 13.5. 13.5.
13.5. 13.5. Okay. So that's that. Now that we have calculated required return of individual security, then the next thing we need to do is to go and calculate alpha value. Okay. Let's go back. We have calculated this. We have calculated this. Let's determine alpha value. So step 3, calculating alpha value. Remember, alpha is calculated as expected return minus required return. So to do this, you are supposed to use a table format that I provided for you. So you start with the name of with the companies that you have investments. You create a column for expected return, another column for required return, a column for alpha. Then if you like, you can create additional column for comments or remark. So this is A, this is B, C equal to A minus B. So we have AHIRA, Bombardier, Courage, then Divine, Okay. So give to me the expected return given in the question. What's the expected return for Ahira? We are given 12% for Ahira. Here is 12%. All these figures, they're in percentage, so just put 12.
9.5.
9.5.
10.5.
10.5 and
13.
13. Then we calculated expected required return to be 11.5.
9.
11.5, 9,
10.55.
10.55,
13.5.
and then 13.5. So we need to find the difference between expected return and then the required return.
First
Okay,
one is 0.5.
0.5,
The second one is 0.5 still.
0.5 minus 0.05, right?
Yes, sir.
0.05,
And
then
0.5.
minus
Minus
0.5.
0.5.
So like I told you, once your alpha is positive, it means that the security is undervalued. So this one is undervalued. Same thing, undervalued. If your alpha is negative, it means it is overvalued. Overvalued. So examiner is asking you in the question, which of the securities is or are overvalued? You can see bonus 9 marks. It doesn't involve any sweating. All right. So I'll just come here. So I will say, we have to go straight to the point. I will say the shares in Courage PLC and Divine PLC are overvalued. Considering the negative alpha value. Therefore, what are they supposed to do? Therefore, the shares should be disposed of. The shares should be sold. That's all you need to do. Because examiner was specific by asking you to ascertain which of the security is overvalued, then that's why we mention only overvalued. Other than that, you have to express all of them. But because examiner was specific, so we did only for overvalue. So that's end of the question. You can see it doesn't involve much sweating, right? 9 marks, you pocket it. So let's have one more illustration before we close the class. Let me stop sharing. Let me know if you have any question on the question we just solved or you have any concern. All right. Anyway, anything that is not clear, let me know. So let's move to illustration number 8 in the study material. This one is a little bit technical than the first one. Yeah, let me see. I need one of you to read for us. Illustration number 8. Who is helping us to read? Ada, you want to try? Ada, are you there?
Yes, sir. Yeah.
Okay, read for us.
Okay. Smaller Funds. Smaller Funds PLC has a portfolio of short-term investments in the shares of 4 quoted companies Um, for Tomiwa, what should I say? Okay,
Skip.
okay, okay. You have the following additional information, blah, blah, blah. The market risk premium is 10% per year, and the risk-free rate is 6% per year. Required A, estimate the beta of SFPLC. SFPLC's short-term investment portfolio. Recommend, given your reasons, whether the composition of SFPLC's short-term investment portfolio should be changed using relevant calculations. Hint, consider the alpha values of the shares and
Yeah.
hello?
Yes, go ahead.
Hint, consider the alpha values of the shares and the propriety of investing short-term funds in equity.
Okay.
So, yeah.
C.
Okay, C. Explain 3 factors that a financial manager should take into account when investing in marketable securities.
All right, thank you, Ada. So in the
Okay.
A requirements, you have to estimate the beta of SFPLC short-term investment portfolio. Remember, in this question, examiner has already given you the beta factor of individual security in the portfolio. So examiner is now asking you to calculate the overall beta of the portfolio. What are you supposed to do? Which method are you using to calculate your beta factor of the portfolio? You can see in this question, you are given number of shares for each company. You are given market price per share. You're also given beta factor of individual security, which means you are going to use the third formula that I provided. You are going to use weighted average method. All right, you are supposed to use weighted average method. So without wasting time, let's quickly go into solving this question so that we can close the class for today. All right. So this is solution to illustration number 8. Still on page 100. All right. Let me confirm the page. Yeah, 100. So examiner is asking you to calculate the overall beta. So I would then say requirement number A. Let me confirm. Is it in A or Roman figure? Yeah, requirement number A. Calculating overall beta value for similar fund investment portfolio. Okay. Which formula are you going to use to calculate your beta value? Like I said, since in the question, you are given number of shares, beta factor of individual security, and then the share price. It means that you are supposed to use weighted average method. So in this case, I will then create a column for companies that you have invested in. Then another column for number of shares. Okay. Then another column for market value per share. Then total market value. Column for beta factor of individual security. Then column for the weights. So this is A, B, C equal to A times B. Here is D, then E equal to C times D. So that's that. CAPM is not difficult. So what are the names of the companies? Give it to me. What are the names?
Tomiwa,
Tomiwa,
Pascal,
Pascal,
Binta,
Binta, and then
Yetunde.
Yetunde. I think we have one Yetunde in this class. Yetunde, speak up. Yetunde, I'm investing in your company. Oh. Your name your name is here. We don't have, there's no Binta. I think no Tom. I think we have one Tomiwa in VI. So, give me the number of shares for each company.
100,000 shares for Tomiwa.
Okay.
155,000 shares for Pascal.
All right.
260,000 shares for Binta.
And then
420,000 shares for Yetunde.
420,000. So give me market value per share.
280 kobo.
280. Remember, when you say 280 kobo, you have to divide it by 100. So that will give you 2 naira 80 kobo. So next one, Pascal.
340 kobo.
340. 3 naira 40 kobo.
150
Binta,
kobo.
that's 1.5. Yetunde,
9.5 kobo.
9.5 kobo. 9.5, 95 kobo.
9.5 kobo.
9.5K.
That is 95.
That should be 95. Yeah. That should be, is it? No, what is what it is? 9.5. So you divide it by,
0.09.
okay. So this will give us 0.095. So to now get the market value, we are supposed to multiply. So multiply for me. Multiply.
280,000 for Tomiwa.
Now, first thing for, hold on. Let's check give me the beta factor for each one.
1.55 for Tomiwa.
1.55 followed by
0.65.
next
1.26.
and then
1.14.
1.14. Okay, so this one will be 280,000. 280 multiplied by 1.55. Give it to me. Yeah?
434,000.
434,000. Then 155,000 multiplied by 3.4.
527,000.
527,000 multiplied by 0.65.
342,550.
342,550. Then 260 multiplied by 1.5.
390,000.
390,000.
390 multiplied by 1.26.
491,400.
491,400. The last one, 420 multiplied by 0.095.
39,900.
39,900 multiplied by 1.14.
45,486.
45,486. Let's add it up. add the total market value and then the total weight.
For total weight,
Yes.
1 million. For
Yep.
total weight, 1 million. 313 436.
313 436.
436.
Okay.
Yes, sir.
1 million.
We have 1,236,900.
236,900. So now that we have the variables we are looking for, then the overall beta, the beta of the portfolio of smaller funds will then be equal to the total weight over total market value, which is equal to 1,313,436 divided by 1,236,900. Give it to me. What you get?
1.06.
1.06. So you can't just calculate 1.06 and stop. You need to comment on that. Remember, I explained that anytime you compute your beta value, you need to compare with that of the market. Therefore, I would then say according to the question examiner is asking you to estimate the beta of smaller funds short-term investment portfolio. So I would then say the beta value, the beta factor of smaller, is it smaller or SF? Let me use what examiner has used. SF PLC. SF investments portfolio is 1.06. This means the risk of the investment portfolio, the risk of the investment portfolio is slightly higher, than that of the markets. Which is 1. Okay, so that's that. With this, I can hand the 4 marks. So number B part of the question, you are to recommend, given your reasons, whether the composition of SF short-term investment portfolio should be changed using relevant calculations. Hint, consider alpha value. In fact, even without examiner telling you to use alpha value, once you can see expected return in a question, if you are given expected return in a question, you need nobody to tell you that you are going to calculate alpha value. So because of time, let's quickly go ahead and solve for alpha. Number B, part of the question, I will then say calculating alpha values. So like I said, to do this, there are 4 different scenarios. 4 different procedures we are going to carry out. The first one is to calculate. Examiner has already given you beta value of individual securities, so you are going to ignore that. The step 2 is to then calculate the required return So I would then say required return, RS, using CAPM. Okay. So to do this, you already know the formula: required return equal to risk-free rates plus beta into market return minus risk-free rate of return, right? So the first company is Tomiwa. So according to the question, the risk-free rate of return is 6%. Market risk premium is 5%. Sorry, market risk premium is 10%. So I would then say 6 plus the beta of Tomiwa as given to us in the question is 1.55. So 1.55. Difference between market return and risk-free rate of return is risk premium. Examiner has given us as 10. So give it to me. 1.55, 1.55 multiplied by 10.
21.5.
Okay, that's 21.5%. Then for the second one is Pascal, right?
Yes, sir.
Pascal, 6 plus, what is beta of Pascal?
0.65.
0.65. 0.65 into 10. So this will give us
12.5.
12.5%. Then beta, 6 plus, what's beta factor of beta?
1.26.
1.26 into 10. That should be 18.6, right?
18.6. Yes, sir.
18.6. Then we have the last
Yetunde.
one, Yetunde, 6 plus beta of Yetunde,
1.14.
1.14 multiplied by 10. So what do we have?
17.4.
17.4%. So now that we have computed the required return, we can then proceed to calculate the alpha value. Okay, alpha. So you know that alpha value equal to expected return minus required return. Okay. So I'll create a column for companies, another column for expected return, required return, alpha, then comments. It's not compulsory, you must put comments, but at times it will guide you when you are making your recommendation. A minus B. So we have Tomiwa, Pascal, Binta, Yetunde. Okay, so give me the expected return for Tomiwa. 21%, right? Expected total return on investment per annum, 21%, then 12.5. Here is 21, 12.5, then 18, then 18.5, 18, 18.5. Then for the required return that we have computed, the first one is 21.5. 21.5, followed by
12.5,
5.
12.5, then
18.6,
18.6, the last one,
17.4.
17.4. So find me the difference. This should be minus 0.5. Oh, look at me. I wrote it something. It's like I started seeing why. So it should be 21.5, 12.5, 18.6, then 17.4. So the difference is minus 0.5.
0.
Here, 0,
Minus
minus
0.6.
0.6,
1.1.
then 1.1 positive. Like I said, if it is positive, that means it is undervalued. You can call it undervalued or underpriced. If it is negative, it is overvalued. If it is 0, that means it is fairly priced. Fairly, you can say it is fairly, rightly, or properly priced. Properly valued. Then this one is overvalued. So examiner is now asking you are to recommend, given your reasons, whether the composition of similar funds short-term investment portfolio should be changed. All right, so I will then come here. So you are going to express. I will then say the shares in Tomiwa PLC and Binta PLC are overvalued. Therefore, the shares should be sold. The shares should be sold. Why? Because the intrinsic value is less than the intrinsic value is less than the market value. Therefore, it's better you just dispose it off. All right. The capital asset pricing model suggested for Tomiwa, for example, for Tomiwa and the Binta, the CAPM, the model suggested 21.5%, but the actual is 21%. That means it is overvalued. All right, so we have advised. That's number one. Then number two, we are going to have three different recommendations. Number two, Pascal, the shares in Pascal PLC are properly priced, are properly valued. Therefore, hence, the shares should be kept. Should be kept. That's all you need to do. Then number three, the shares in the shares in, is it Binta?
Yetunde.
Yetunde. Yeah. The shares in Yetunde PLC are undervalued. Therefore, they should be more of it. Therefore, more of the shares should be bought. More of the shares should be bought. All right. So that is our recommendation. That's our recommendation. So what else? The last part of the question. Examiner is asking us. Yeah, let me open. Examiner is asking you to explain 3 factors that a financial manager should take into account when investing in marketable security. So you need to personalize this. Put yourself in the position of a finance manager, right? Put yourself in a position of financial manager. You want to invest in short-term marketable security, for example, treasury bill. What are the factors you need to consider before investing in treasury bill? Factors to consider, right? What are those factors? Let's say, for example, you have ₦1,000,000 and you want to invest that ₦1,000,000 in treasury bill. What are the factors you need to consider? Of course, the first thing is your initial capital, right? Initial investments. Number 1 factor is initial investments or capital outlay. If you don't have, this is the amount you want to invest in the marketable security. The higher the initial outlay, the higher the amount of investments that will be made. Then number 2, you need to consider the tenure of your investments. How long with the investment? This is represent the duration of the investment. Is it for 3 months, 6 months, 1 year? So remember, it's a short-term marketable security. It's usually 1 year down the line, between 3 months and 1 year. All right, so that should be the tenure for short-term marketable security. Then number 3, talk about liquidity. I want to know, liquidity is the ability to convert the investment into cash. Anytime you need money, you can easily dispose it off and use the money for whatever you want to do. So, right, so that's essence of liquidity. For example, if you buy treasury bill now and you are in need of money, you can't wait for the next 3 months or 6 months or 1 year that the treasury bill will mature. You can dispose it off and then you get your money back. So it should be liquid enough. Then 4, you need to consider the impact of inflation. All right, you consider the impact of inflation because when there's price level changes, the value of your investments may decline. Therefore, it's a factor that you need to take into consideration when you are investing in short-term marketable security. Then number 5, you also need to consider currency risk. Okay, you need to consider currency risk, as particularly if your investment is denominated in a foreign transaction. All right, so you consider currency risk. Okay, that is if your investment is denominated in a foreign transaction. I mean, it's denominated in a foreign currency other than your domicile currency. Because if the foreign currency appreciates relative to your domicile currency, then the value of your investment will fall. All right. Then number 6, you can also consider taxation. What will be the impact of taxation on your investments? Okay. Then number 7, you can consider default risk. Default risk. Default risk is the inability, is the chance that both the interest and the principal, you may not get both the interest and the principal. All right, that's the default risk. So default risk is inability to pay interest and the principal as and when due, So that's default risk. So you also you want to be sure that you can get your interest as and when due, and then when the investment mature, you get your capital back. All right. So these are some of of course, you can also consider you also need to consider government policy in relation to that investments, whether do we have a stable government policy, all right, whatever it is. So
what about rate of return, sir?
Yes, it's also part of it too. It's rate of return, which is your coupon in this case. That's your coupon payments. All right. So you consider your coupon payments. Number 8, coupon. All right. So these are some of the factors. So if you can just list like 5, you are good. So that's that. It's not just about listing them. You need to talk about you briefly talk about each of them. What do you mean by taxation? What do you mean by currency risk? What do you mean by inflation? So these are the things you need to talk about. All right. So let me know if you have. This is where we are going to call it a day. So by the grace of God, in our next class, we are going to have. Yes, Rose Simon, talk to me quickly.
Please, can you just expatiate on that coupon payment?
Coupon is the interest you are going to get on your investment. And you know, for example, if you want to invest in short-term marketable security, you are going to get, let's say, for example, you have ₦1 million that you want to invest in treasury bill. When you make that investment, immediately you are going to get your return. So just like interest, you are going to be paid immediately. Then your capital will go in there after the tenure. Then the capital will be paid back to your account. All right, that's how it works. Okay. So any other question so that we can close the class? Yeah. All right. So in the absence of no further question, this is where we are going to call it a day. In our next class, we are moving to working capital management. We have 2 more to go, working capital management and then business valuation. So when we meet on Saturday, by the grace of God, we shall be having working capital management. All right. So thank you guys for your time and patience. I will see you next time by the grace of God. Good night, everyone.
Hello, sir. I wanted to ask you something, please.
What's your question?
Okay, for the ROM minus ROF, you use 10. So I want to ask, is it the same thing as the market risk premium?
If I use 10, that means a market risk premium. If I use 10 without minusing RF, that means a market premium.
Okay, sir. Thank you.
You're welcome. Okay.